Good afternoon. Welcome to Money Minutes. My name is Marco Segrera. I'm an advisor with Evensky and Katz here in Coral Gables, Florida. The goal here at Money Minutes is to give you, our listeners, a bit of information to help you live better financial lives. Today we'll be looking at a quick view of Roth IRAs, and specifically when taking distributions from Roth IRAs, how to avoid taxes and penalties. Right? The first thing to realize is that within any Roth IRA are usually going to be a combination of what we would consider three types of dollars, or at least three different personality types of dollars, which I've illustrated here. Number one, we have our contributions. Number two, conversions. And lastly, earnings. Simply stated, contributions, the amounts that you've contributed to these accounts based on IRS allowed limits, which for 2019 is $6,000, and it's an additional $1,000, so $7,000 per year if you're over the age of 50. Conversions are amounts that you had in a traditional IRA that you paid taxes on and then converted to Roth IRAs. And then lastly, earnings is most likely the reason you opened up a Roth IRA to begin with. These are the actual investment earnings on the conversions and the contributions that you've made over time. So starting with the easy one here, contributions, always no tax and no penalty. You always have free access to contributed amounts at any moment in time. Reason being, IRS is not going to levy any penalties. You've already paid taxes on these dollars. There's nothing to worry about. If you contributed $6,000 in 2019, the day after you contributed, you can then withdraw those $6,000 as a return of your contribution. Second, conversions. Here's where the rules start to apply a bit. The first one is what's called the 5-year rule, right? For each conversion, you start a clock that has to cover 5 years. As an example, if I contributed $5,000, whatever the number is, December 30th of 2018, my clock started not on December 30th, actually on January 1st, 2018. The IRS has a funny way of looking at it in that no matter what day of the year that you make the contribution, that you make the conversion, they're always going to look at it happening on the first day of the year it happened. So if I make a conversion on December 30th of 2018, my clock actually starts January 1st, 2018. So 5 years later, that's when I'll meet this metric right here. Each conversion after that has its own 5-year clock that it'll have to hit. But in the case of conversions, this isn't the only way that you can pull money out. The other ways that you can hit it, 4 other ways, is dying or becoming disabled, abbreviated DEDI, right? The other 2 rules being reaching age 59 and a half, or your first home purchase. Quick note that if you are tapping your Roth or Roth IRA for your first home purchase, that's only up to an amount of $10,000. Lastly, earnings, right? Kind of the meat and potatoes of why you have this account. Exact same rules as your conversions, except a big change. Instead of or, it's and. In order to access your earnings tax and penalty free, because well, remember, conversions are amounts that I've already paid taxes on. So what you're avoiding by either hitting this 5-year rule or one of these 4 rules is the 10% penalty that would be levied. On earnings, you're trying to avoid taxes and penalties. So in order to avoid both of those things, you need to beat both of these rules. So it's the 5-year rule and death, disability, 59 and a half, or your first home. And like I mentioned before, up to $10,000, right? So that's taking distributions from a Roth IRA. We hope this was helpful. We hope to see you again next time.